Bloomberg Audio Studios.
Podcasts, radio, news.
I'm going to bring in now Stephen Englander, a global head of G10 FX research over at Standard Chartered Bank. So careful policy approach, like that's what has stood out to me. That was a quote from Lisa Cook, careful policy approach. How do you express that when it comes to then the dollar?
Well, I think the market, before it sells the dollar, wants to see that the dollar is kind of on the front lines of cutting. And, with the S&B cutting, the Swiss National Bank cutting last week ahead of everyone else, discussion about whether Bank of Canada, ECB are going to be cutting and when they might cut, the market's unwilling to sell the dollar on this. We do think that if everybody cuts at the same time, it's going to be very risk-on. And that kind of risk-on environment tends to be dollar negative, not super dollar negative, somewhat dollar negative. But for the dollar to be really soft, dollar has to go faster than everyone else and reduce those rate differentials. And so far, that doesn't seem to be what the market is seeing.
So for the dollar to get materially weaker, we need the Fed to cut harder and faster than other central banks. And you don't see that really happening.
Well, the market doesn't see it happening.
Okay.
We're a little bit on that side. We see 4 cuts this year. We think they're going to cut in June. There's an outside chance that they cut in May because if you look at it, they're cutting 3 times with a median of 2.6%, 2.5 to 2.6% inflation. There's an outside chance we'll be there by May. So I wouldn't preclude it if that's the threshold. But the market's waiting to see it happen. I mean, unfortunately, they're not acting on our forecast.
But what's actually driving this, though? I mean, against the economic backdrop, I mean, there were a lot of people that looked at the Fed meeting last week and thought, okay, is this maybe a little too dovish? I mean, I know that's what the market wanted, but against that economic backdrop, why are we still talking about 3 to 4 cuts?
Well, you might call it yield differential preserving cuts.
Okay.
So, if everybody cuts by, 50 basis points over 3 months, the Fed is still the high yielder.
Right.
And the market's saying, what difference does it make if it's the Fed 5 1/4 and everybody else 3, or the Fed 4 3/4 and everybody else 2 1/2?
Okay, so this is more about the relative game for investors here. Then let's fold the yen into that conversation, because if there's any sort of relative relationship that's been out of whack over the last few years, it's been yen versus probably, I guess, the rest of the world.
Yeah, look, the Bank of Japan has been obsessed with the long yen, whether it's because of Japanese government debt, which will have a problem if the long end moves up too fast, or because of the situation of Japanese regional banks. What they did at the meeting was kind of say, we're getting rid of YCC. The title, but everything we did under YCC we can pretty much do in the future if we decide that that's what we want to do. And I think the market was pretty dissatisfied with that. On the other hand, they do seem concerned about the yen weakening. And some of the comments that's coming out since then suggest that maybe they see a little bit more room for moving quicker than the market had anticipated. So that would help the yen.
I mean, they definitely have verbally been in the market. It just hasn't done anything to really help support the yen. And is the yen ever going to get some real steam to the upside, for example? Because no matter what, the rate differentials are going to be huge. Even if the BOJ hikes and the Fed cuts, for example, it's still going to be a fairly large differential.
Well, I think moving down by 25 basis points isn't going to do much. There's an old children's story where the punchline is soft ice cream is soft ice cream. 250 basis points of real yield is 250 basis points of real yield. It's very hard to resist. I think over time that should compress. And the question I keep asking myself is, all you're going to do is 10 or 20 basis points. Why bother? It's not as if anybody cared that you were kind of minus 10. For some rates. So it's quite possible we'll see a more aggressive BOJ.
Interesting. Also, I guess I find what's interesting, too, is that with the repatriation thing we were all waiting for and sort of the unwind of the carry trade, is that going to happen? If, as you say, 10, 20 basis points hike, who cares?
Well, strangely enough, even though we're all talking about the U.S. equity market, the Japanese equity market has way outperformed, whether in common currency or local currency. The Euro area equity market has outperformed. So, there is a question if the market decides that some capital should be going back because there's value there, and that would be a big help. So far, that hasn't been the decision. It's more focused, as we started by saying, who goes first, and so who do we hit first?
All right. Stephen, always great to talk to you. Stephen Englander, Global Head of G10 FX Research over at Standard Charter.